let's go back to the general ledger for a moment and discuss that. On the diagram, on page 1.1, you'll notice the general ledger is broken down into these four categories of accounts. And on the left-hand side, we have above the asset name, what does it say? Just right up above it. Debits. Okay? And on the right-hand side, what does it say? Credits. Debits and credits are one of the most misunderstood parts of the entire accounting process, yet they are the fundamental building block of the double entry accounting. And it really hasn't changed in 500 years. Okay? I mean, the books that Fra Luca Pacioli back in Italy created back in the late 1400s weren't much different than what we do today. The tools have changed. Today we use computers to do it. He used to use quill pens and parchment paper. But this process is very similar. And debits and credits have been used all those years. Now, here's the confusion. Okay? I'm going to tell you today, and you might have to just take my word for it to begin with, that assets are debits. Okay? Now that goes against a lot of people's nature. The reason why is because we like assets, don't we? Okay? Assets are good. The more assets we have, the happier we can be. Okay? Right? Liabilities, on the other hand, which are shown in the right side of our general ledger, we don't care for them too much, do we? Okay? We don't like debt. But I'm going to tell you that liabilities are credits. Now, the rub is, if I were to take a general survey of the public and ask them which ones are better, debits or credits, what would most people tell me? Credits. Credits are good. We like credits. Now, why? Why have we been conditioned to like credits? Credit cards. Good. What else? Okay? Banks. What does the cashier say they're going to do to our accounts? They're going to credit our accounts. And we like deposits, right? And so we think, well, credits are good. And besides, then they say, and by the way, we've got to make an adjustment to your account and take some money out. And they send us a little form that's called a what? A debit memo when they take money out of our account. We don't like debits because that means our account's going down, right? And besides, if you remove I out of debit, what does that word become? Debt. Yuck. Okay? And so we like credits. We hate debits. You know, I mean, that's generally the attitude people have. Now, what am I telling you up here? I'm telling you assets are debits. All of a sudden, that's just completely opposed to what most people grow up believing and understanding, okay? But I want to tell you, it's not me saying this. This is the way it's been done for 500 years, okay? Now, here is... Let me just go through and show you how debits and credits are developed, okay? And then I'm going to come back and answer for you why we get all confused, okay? If you have a transaction, there are always two parts to every transaction. And if you can answer what those two parts are, you can solve any transaction, identify the debits and the credits, okay? Every transaction, from every transaction, you got something, okay? Sometimes it's not as easy to figure out, but you got something. And it came from someplace. Now, if you can figure out those two things, you can figure out the debit and the credit. Because the debit represents what you received. The credit represents where it came from. And if you can identify those two concepts, you're in good shape. Let me give you a couple examples here. Okay? Let's imagine that we're going to start an accounting freelancing service, an accounting business. Okay? And the first thing we do in our accounting business is take $500 that we've been saving in the cookie jar at home, and we go down to the bank and we deposit it into a new checking account for our accounting business. Okay? Now, frankly, we're going to enter this into this journal, this deposit. It's going to go in there because it's a cash receipt. But let's look at what happens in the general ledger when we enter it into that journal. What did we get? What did the business get? $500. $500. We're going to put it into the bank, okay? So we're going to put, there's a bank account in our general ledger in the asset section, and we're going to increase that account $500, okay? Now, the next question is, where did it come from? Okay, why? Tell me where, what was the source?
Personal money.
Okay, so the owner gave it, or what we call invested it in the business. Do you follow that? So if that was you, you invested $500 in the business. The business doesn't owe it back to you. Okay, you can take it back, certainly, but it's not a debt, as other debts might be. So we're not going to put it in the liability section. We're going to have an account down here in the capital section called Owner's Investment. And we're going to increase that account $500 as well. Now, for every debit, we must have an equal, for every entry, we're going to have equal debits and equal credits. Do you follow that? Do our debits equal our credits? Which one's the debit here? The bank account. Okay? So we're going to debit the bank account. People always ask me, why is it DR? I mean, that makes no sense. Well, DR was an old abbreviation that used to stand for debit record. Okay? So, and it's just held for years, probably centuries. I don't know how long they've been using that DR. But we usually refer to it as DR. Okay? And is this a debit or credit? Owner's investment. Credit. And that's because it shows where that came from. Do you follow that? Okay? Let's look at another transaction. Next thing we need to do is we need a computer. So we go down to the computer store, and they have a deal where we can buy our computer and pay for it over the next 6 months. Okay, we don't have to pay anything now. We just bring it home. Now, what did the business get from that transaction? Computer. Is that an asset? Okay. So we're going to have a computer. Is this going to be a debit or a credit? Huh? Debit. Because this shows what we received. Do you follow that? Okay. Now, where did it come from? Do we owe back for it? So it's a debt, right? We're going to have to pay that computer store. It's not like this one where we don't own the owner money back. It's up here. It's a debt. It's a liability that we've got. And so we're going to have a liability called computer loan up here. And it's going to be $1,000. Okay? Now this is the debit because this shows what we got. This is the credit because it shows where it came from. Do you see that? Now most transactions we have are this easy to figure out. You can very quickly pick out what we got and where it came from, and you've got debits and credits mastered for those transactions. Some of them get a little bit more difficult to figure that out, and that's why we're going to spend quite a bit of time drilling those later on, so that they become very mechanical for you, so you don't have to think through them. You can do them very quickly. Okay? Now, we mentioned the banks. We mentioned the fact that when we deposit money in our account, they say that they're going to do what? Credit. Okay? And so people get very confused by that. I want to show you why that happens. Okay? Because they're doing it the same way. But they're looking at it from a different perspective. Okay? Anybody know what that perspective is? Karen?
It's a liability on their books.
Exactly. Do they owe that money back to you? When you put money in your account, whose money is it? It's your money. The bank owes it back, don't they? Okay? So, and what did I tell you liabilities were? They're credits, okay? Now they have an account on in their liability section called depositors payable. And this represents how much they owe their depositors. So if you come in and put let's say $800 into your account, okay? That's going to increase their debts because now they owe $800 more to their depositors, right? They also have an asset account over here called cash in vault. Because where are they going to put your $800? In the vault. So that's going to go up by $800 as well. Which one's the debit? Cash in vault, because that's what they got. They got $800. Where did it come from? Their depositors. And they owe it back. Okay? So that's the credit. They're sitting on the other side of the counter. And so their credit is our debit. On our books, we're going to increase our bank account as a debit, aren't we? Okay? So that's the reason people get so confused, is they see the one perspective, or they hear the one perspective by the cashier. They don't hear the other perspective, which is our perspective. We as bookkeepers and accountants understand the difference and record it accordingly. Okay? Does that make sense to you? So debits and credits are used the same throughout the world. And once you have a good foundation in debits and credits, you can keep books in virtually any country in the world because they all deal with the same system as what we're showing here.